For my first 3 years of trading, I had a terrible superpower. I could predict exactly where the market would go precisely 1 pip after it hit my 20 pip stop loss. It felt like the broker was hunting me. But the truth, I was trying to negotiate a ransom that the market had already set. I'm Dennis. I have not blown a trading account since October 2013. Not because I got smarter, but because I stopped guessing safety and I started calculating it. In this video, I'm going to show you how to install the volatility AMA mechanism so that you stop donating money to market noise. First, I'll prove why your fixed stop loss is statistically guaranteed to fail. Next, I will give you the ransom formula, a simple calculation using the average true range indicator that explicitly defines the noise zone. And finally, I'll show you the risk paradox, how to pay that expensive ransom without risking a penny more of your account balance. If you are tired of being right about the market's direction, but wrong about the trade, this is the upgrade that you need. You have been told that to be a safe trader, you must use tight stop losses. You set 20 pip stops to keep your risk small, and it sounds logical. But by saving on distance, you are actually guaranteeing a loss. This is the single biggest reason part-time traders bleed their accounts dry while being right on the market's direction. You justify it like this.
I have a small trading account. I can't afford a wide stop loss. I will put it 15 pips away. If I am wrong, I want to be wrong first.
Back in 2013, I was trapped in the 20 pip cycle. I would see a perfect daily setup. I would enter, but I was terrified of losing. I would place a tight 30 pip stop loss thinking,
I am being a prudent risk manager.
Then I would watch the screen. The market would wiggle down 31 pips, take me out, and immediately rock 100 pips in my direction. It felt personal. It felt like the broker had a target on my back. But the truth was painful. I was trying to negotiate with the market. You see, every market has a daily entry fee, what is called volatility. If the market naturally moves 100 pips a day on random noise and you enter a 30 pip stop loss, it is like standing in the middle of a busy highway trying to dodge traffic. You are not managing risk. You are paying a hidden tax for ignoring the environment. I realized my account trading budget, what I wanted to lose, did not matter. The market demands a specific fee to stay in the trade. Real risk managers in trading look at that chart and think, this market moves 50 pips a day. A 20 pip stop loss is a donation. I will pay the full price to stay in the trade or I will not play at all. You have to stop looking at your stop loss as a tool to save money. A stop loss is not there to protect your wallet. It is there to prove you wrong. And that brings us to the core concept that you need to adopt. The ransom principle. The market charges a ransom, volatility, to keep your trading position open. You can't negotiate this with your account size. You pay the full ransom to clear the market's noise or you don't trade at all. Never use fixed pips. Amateurs guess, but professional measure. So if we cannot simply guess 30 pips, so how do we know exactly how much the ransom is? That is where a specific tool comes in. Most traders execute their trading entries with sniper precision, but they place their stop losses blind. They say,
that looks like a safe spot.
That is not a strategy. That is hope. To stop getting stopped out, you must stop trading the static and start trading the signal. You think,
I will put my stop loss below that candle. Hopefully, price doesn't go there.
Think of noise-cancelling headphones. They filter the background hum so that you can hear the music. Market price has a background hum that is called the noise zone. Random jiggles, buyers and sellers clashing. When you place a stop loss inside this noise zone, you are not exiting because the trend has changed. You are exiting because of static. The legendary turtle traders understood this. They did not guess support. They calculated N, a mathematical measure of that day's noise. They knew they could not predict price, but they could measure the market's noise. Since 2016, I stopped guessing. I started using a volatility speedometer called the average true range. But when you switch to thinking like a professional trader, you will say, I do not care what the chart looks like. The ATR says the noise is 60 pips. My stop loss goes at 65. Math over feelings. You do not need complex formulas. You just need to know where the static ends. So here's the microsystem that I now use. I call this the dynamic buffer rules. Number 1, check the gauge. Load the ATR indicator on your chart with a 10-period setting. This is the average daily range of the last 10 days. Number 2, calculate the buffer. For Forex, I multiply that ATR number by 0.8 or 80%. For volatile assets like crypto, stocks, and metals, I use between 1 times to 3 times the ATR number. Number 3, place the stop loss. Take your entry price and add or subtract that buffer. Why? You stop saying, I hope 30 pips is enough. You say, math proves that 80% of the time the noise will reach here. You are mathematically protected against luck. You are likely saying, Dennis, will a wide stop not risk more money? We will solve that math paradox in 30 seconds. But first, do you know the real root cause of your losses? I created a free 3-minute diagnostic quiz to identify the specific system failure in your trading. Click the link in the description to get the personalized diagnosis that I wish I had when I was starting out. This fear traps small accounts. You believe a wide stop loss equals high risk. Mathematically, that is dead wrong. The fear usually kicks in and tells you,
I cannot use an 80 pip stop loss. I only have $5,000. That would wipe out 10% of my account.
Let's look at 2 traders. Trader A, the defensive miser. He buys the euro dollar. His account is $5,000. Risk $50. He buys 0.1 lots. To risk $50, his stop loss must be 50 pips. But the volatility is 80 pips. He gets stopped out and loses $50. Then we have Trader B, who is the professional. He sees the 80 pip ransom. He must use an 80 pip stop loss, but he only wants to risk $50. So what does he do? He does not touch the stop loss. He changes his position size. Instead of 0.1 lots, he calculates that to risk $50 with an 80 pip stop loss, he needs, let's say, 0.06 lots. Both risk exactly $50. Both lose $50 if wrong. But Trader B has a volatility armor. But Trader A is naked in the market storm. The professional trader does the math and says this: the stop loss needs to be 100 pips wide. Fine, I will cut my lot size in half. My risk stays at $50, but my trade gets room to breathe. This is what I call the risk paradox. You can afford any stop loss distance if you adjust your lot volume. And here's the formula that you must use before every trade. Number 1, determine the ransom. Calculate your ATR-based stop loss distance first. For example, 100 pips. Number 2, set your budget. Decide on your fixed dollar risk. For example, $50. Number 3, calculate the size. Divide your risk $50 by the stop loss distance 100 pips. The result is your position size. You adjust the lot size to fit the stop loss. You never squeeze the stop loss to fit the lot size. But sometimes the market goes crazy. Sometimes the ransom is 300 pips. Does this math still hold up? There is a limit. And recognizing it separates the disciplined trader from the desperate ones. This is when FOMO usually whispers.
The market's volatility is insane. But if I catch this trade, I will be rich. I will just risk a little more just this one time.
Imagine non-farm payrolls, NFP. The market whips wildly. The ATR ransom spikes to 200 pips. You run your pro entry stake formula, and to risk your standard $50 with a 200 pip stop loss, you need a tiny position. Worse, your target is only 100 pips away. So risking 200 pips to make 100 pips, the math is broken. You are risking 2 to make $1. This is what I call the capital-fueled fear cycle. You want to force the trade, and so you think,
maybe I will tighten the stop loss.
but the risk manager in your head steps in and says, the entry fee is too high. The risk to reward is broken. I am vetoing this trade. Do not do it. Exercise your power as the manager of your trading account. I call this the volatility veto. If the average 2-range stop loss destroys your risk to reward, risking $2 to make $1, or forces the size below the broker's minimum, you issue a veto. That is, you are not missing out. You are declining a bad deal. The market is asking a ransom that is not worth the price. So walk away. That is how you survive. So now you have the volatility armor to stop the bleeding in your trading account. But defense alone will not make you money in trading. You need to spot winning setups instantly so that you don't waste trade protection on garbage trades. Check out this video where I show you the exact trading candlestick patterns and signals that I use to spot high probability trades instantly. See you in that video.